Auto loan apocalypse. Be ready for a surge in the availability of pre-owned autos. The epidemic, like so many other recent economic shocks, will be to blame. The COVID-19 pandemic caused changes in people's lifestyles that no one could have anticipated. Families that used to live in congested flats and concrete jungles relocated to suburban regions with yards and trees. Even reliable modes of transportation, including trains, subways, and shuttle buses such as these, quickly lost their consistency. So, autos were a need for everyone. This shift in demand, mixed with global supply chain challenges, boosted automobiles to the status of a valuable commodity. As a direct outcome, the cost increased by double %. However, recent statistics reveal that the auto industry is losing steam. Prices are set to go down for the first time in years. Here's why. First of all, this isn't 2008 like the housing crisis. The year 2022 is experiencing a severe crisis of automobiles. If the housing market's collapse was like a right jab to us, then the upcoming collapse of the used car market might be more like a left jab. Yet, the shift we are seeing is notable. In the past, a vehicle's value would begin to decline as soon as it was driven off the lot. At least, that was the scenario until early 2020. This year, the return on a vehicle purchased 2 to 3 years ago is expected to be higher than the return on a 401k. In light of the average rate of depreciation, the following graph depicts what a used car bought in 2020 should be worth right now. Now, focus on the blue line, which represents the actual market value of the automobile. It's not even close to the trend. It's hard to fathom, but the used automobile market has ballooned to a level that's not feasible throughout the course of the industry's long-term existence. Now, the question is, what causes a shift to occur? The real fix is in the hands of the customers. Many people nowadays struggle to make ends meet, and one indicator of this is their inability to keep up with their auto loan payments. According to Edmunds, an online automobile inventory and information portal, around 13% of new car purchasers make payments of at least $1,000 per month. According to Cox Automotive and Moody's analytics research, these figures are unprecedented. Remember that this is for an asset with a long history of being a rotten financial bet. In contrast, the median mortgage payment each month is $1,600. As a result of the epidemic, people were able to keep more of their hard-earned money because of debt forgiveness, stimulus checks, and improved unemployment benefits. But when those incentives dwindled, automobile purchasers were left holding the bag. Many buyers are now falling behind on auto loans from 2020 to 2021. Likewise, the mortgage crisis in 2007 was brought on by predatory mortgage lending and unregulated markets, both of which made it possible for unqualified borrowers to get mortgages for houses at inflated loan-to-value (LTV) ratios amid a price bubble. It thus led to the disaster. In fact, that's the situation in the car lending industry today. Due to a lack of new vehicles, consumers are paying thousands more than the manufacturer's suggested retail price, MSRP, for their purchases. In contrast, the value of used cars has risen to the point that they sell for more than their brand new counterparts. In the same way that mortgage lenders in 2007 did not do adequate credit checks before approving applicants for loans, whereas auto lenders are now extending credit to buyers for amounts more than 110% of the vehicle's worth. Since 2007, mortgage authorities have tightened their grip on the home lending industry, and lawmakers have passed regulations to safeguard borrowers and financial institutions against a repetition of the disaster. Barron reports that there has been a dramatic increase in repossessed autos around the country over the last 12 months. In some instances, the loan-to-value or LTV ratio of the customer who purchased a repossessed car was more than 130%, and the dealer must auction off the vehicle. That's a reasonable estimate, but Barron's reported that one dealer was seeing ratios of 140%. However, LTV, or loan-to-value, measures how much of a loan was used to purchase a car compared to how much that vehicle is worth. In other words, borrowers are falling behind on $26,000 in auto loans while buying automobiles that are only $20,000 in value, which is 130% LTV. Furthermore, what's even more concerning is that this isn't bound to subprime borrowers. Yes, the default rate for subprime borrowers is still more significant than that of prime borrowers. Nevertheless, Barron's claims that the default rate for both categories has doubled since 2020. The default rate for subprime borrowers climbed from about 6% to 11%, while the default rate for prime borrowers increased from 2% to 4%. Further, the problem becomes much more severe as we expand our perspective. In 2021, a study by Consumer Reports found that 1/4 of borrowers might not have been able to repay their loans. But now, the auto lending industry is following in the disastrous footsteps of the mortgage lending industry. As of the 2022 first quarter, 8.5% of subprime borrowers have defaulted on their vehicle loans, according to data from Equifax. Since then, the cost of living has soared due to high automobile prices, which is up by 22% from this time last year, rising loan rates, which are up by 1.5% over the previous 3 months, and soaring inflation, which is 8.2%. The world's end as we know it in terms of car loans is just around the corner, as inflation remains at record highs and the United States officially enters a recession. Similar to the housing market, the value of automobiles is expected to fall as the number of defaults rises and the number of repossessed vehicles enters the market. Consumers who are unable to continue making their monthly payments will be unable to sell their automobiles because they owe more on the loan than the car is worth due to high LTV and decreased vehicle values. There has been an increase in the number of vehicle defaults. There is a greater supply of used automobiles, and fewer customers are able to secure loans as a result of their credit ratings falling. Meanwhile, the cost of borrowing will rise as it becomes more difficult for car lenders who packaged and marketed their loans to investors to unload their debts. The day will come when authorities will intervene. Customers will be saddled with crushing debt, ruined credit, and the inability to buy a car. If your vehicle costs more than 10% of your monthly salary, consider selling it. At the same time, the market is still high, and purchasing something cheaper or buying a car with cash so you don't have to worry about the approaching apocalypse. Anyhow, it's possible that the rates of default on auto loans for Generation Z and millennials will continue to climb, posing a severe threat to the borrower's future financial security. So, learning how to avoid auto loan default will help you avoid these adverse effects on your credit score and debt that might occur if you are a young vehicle owner who has just started driving. However, a commitment comes with each increase in financial independence. Gen Z and millennials are in the midst of a loan debt crisis, and you can do your part by talking to your lender before you acquire a car loan, working to improve your credit, and exploring other banking choices if you're having money problems. And if you want to avoid the potential long-term implications of defaulting on a vehicle loan, it's essential to take the appropriate financial steps beforehand. So, what does all of this mean? It seems that an increasing number of individuals are falling 1 or 2 months behind on their vehicle loans, but they are not allowing the delinquencies to result in defaults. That's a good thing. If this pattern of conduct doesn't end, what will? That's up to speculation. Recall the year of 2008, when everyone had trouble making their mortgage payments. This has a familiar ring to it, at least. So, let's see what 2023 holds. Thanks for watching this video. I really hope you enjoyed it. Additionally, if you're new to this channel, I strongly encourage you to subscribe and click the like button. You can also keep up with all of my most recent videos. See you in the next one.